welcome back to the Intelligent Investment Market Update. Excited to be back with our first 2024 version with Matthew Dahl. So thanks for being back, Matt. How were your holidays, dude? I know you had a crazy holiday season combined with an office move. So I want to say how are your holidays, but I kind of know that they weren't the best probably.
Yeah, basically November 1st through December 31st of last year, I think aged me 25 years. The building that we were in, anyways, the guy, the landlord, a big attorney firm town, great guy, friend. He's like, hey, I'm expanding, you're expanding, we're going to grow into each other. So I'm like, okay. So long story short, I found a really good place, but part of it was they said, you kind of need to be in here by January 1st. I was like, okay, fair enough. I'll do it. So negotiated everything, that goes. And then for the next basically 35 days, it was paint, carpet, all that stuff, moving into the new place, getting movers ready, getting installers. It was just a nightmare. During Christmas, which of course, and of course we had to have Christmas for everyone because that's what we do every year. So we had a big Christmas dinner and putting on Christmas itself for everyone, plus a Christmas dinner, plus a Christmas party for my staff, plus moving the firm. It's just like, so I was really happy to ring in 2024. Last year was a good year for the markets. What last year did was recovered the 2022 inflation, interest rate, pain that we all had to suffer. So, we finished 2023 at 40, call it 47.70, 47.69 and change. And it's funny is yields actually through the course of 2023 went up. If you look at it through the 10-year treasury note, actually went up quite a bit, about 60 or so basis points. But what the reason the market recovered was because the market's now pricing in lower rates and a more accommodative Fed in 2024 and 2025, right? So we thought the beginning of 2023 that there would be some sort of consternation during the year, but frankly, it really took off immediately into January. And other than the two instances, the one in March with the Silicon Valley banking crisis that we had, that brought the market down to flat for the year in March, but then it took off again. And then we had that sort of 90-day 10% correction from basically August 1st through November 1st. In fact, the closing low was that day. In fact, I think we called it right here on the show. We said we believe it was, I think it was a show after that show where we said that 41.17 on October 27th, we believe that to be the closing low. It turned out it was. So, it's for that little correction cycle. And then basically from October 27th through December 31st, the market ran 550 points. The S&P ran 550 points. So, that's pretty solid. What we're seeing now in January is a little bit of a give back, but not today. Today's actually pretty good. Today's we kind of had a 3-week internal correction cycle. We had some market breadth. The market breadth kind of waned a little bit. It kind of contracted, and a lot of that had to do with the yields. If we look at Q3, Q4, and again, we're always kind of using the 10-year treasury. That's just kind of our benchmark. Right? Typically, we see a round trip, and that's what's happened, right? So Q3, we started at 386 on the 10-year. We finished Q3 at 457 on the 10-year. So it jumped, 70 basis points, right? Q4, it did the exact opposite. We started at 457, actually 459 because it went on the weekends. But we finished at 388. So it round tripped it within 2 basis points. The yields are circling the drain. Does that make sense? It's spiraled. Okay.
Yeah, I got you now. Yeah.
We had some good economic data. CPI came in a little bit hotter than consensus, not too bad. Came in at 30 basis points, as on consensus of 25. No big deal. The PPI came in actually cool, which was good. Nothing. Jobs have come in strong. The UMich came in at 78.8 today, right? Consensus was 69.5. So consumer sentiment came in hotter than expected. So which caused another little pop in the yields. But it's not, I don't think we're going to retreat back to sort of circling the drain here. We're not going to go back to 457, in my opinion. Knock on wood here, knock on wood, right? I don't think we're going to go to 457. I think we're going to go to probably simple Fibonacci retracements, 38.2 or 50% of that 70 basis point move. So call it a 30 basis points to about 35 basis points, somewhere in there. So if you take 388 and you put 30, you put a 30 on it, there you go, 418. We're sitting at 417 this morning. So I think we're kind of at the very upper end of where the 10-year is going to go. 415 to 420, it might go to 422, it might not, but I think we're kind of there. And from there, I expect yields to roll over and retreat back. What we're seeing in the equity markets, actually, it's January 19th. We saw it yesterday and today after sort of a 3-week internal slow moving, not correction, just sort of a consolidation period, right? Is the equity markets are now starting to get ahead of the bond markets a little bit, saying, okay, we think yields are going to roll over, and obviously it's going to be good for equities. And I think there's going to be a much bigger rollover into the spring. I think that's when our small caps are really going to start to run. I think that's when the market breadth will really start to expand. We'll see the equal weight S&P outperform the cap weighted S&P.
So this may end up being a slight segment transition, but you kind of brought it. So if you don't want to go here, we don't have to. If you don't want me to go ADD on you, but so at the risk of maybe diving into something we don't want to get into here, I am really intrigued about Fibonacci, and I don't really know anything about it, and you just happened to bring it up. So I don't know if you want to talk about Fibonacci and the concepts of that in the show here, but if you know enough about it to bring it up, I'm hoping maybe you know enough about it to tell me what the heck it is. I get the concept of Fibonacci. I know it's a sequence of numbers found in nature. Is there a reason that we should be paying attention to that, or what is the reason that we should be paying attention to that in the market?
Right. So it's basically the golden ratio, 1.618. Okay. And it's effectively, if you look at population dispersions, if you look at both in animals and humans, it kind of works through these levels. In the first level of Fibonacci retracement is 23.8, 23.6. It's been a minute since I've studied all of these. Second level is 38.2. The next level is 50.
And I'm going to interject here. It's what we're kind of referring to there is almost like cycles within cycles within cycles within cycles.
Right. Right. So typically, if they're, let's say you have a move of 100%, right? Typically, you'll see and there's a retracement of that move. You have levels that it will retrace to. Typically, as found in nature, as found in many different things. Okay, again, population dispersions. It's really cool. You'll see that come down 23.8% or 38.2, or right at 50, or right. I believe the last one was 68.9 or 60, something like 69, and then above that is 100%. Okay, so you kind of see when something kind of does this and then pulls back down, it'll pull back down to one of those levels. Okay, and I think because it has to do with the mathematical relationship of the successive number and the relationship of 1.618. These trading algorithms, right? Because a lot of these big machines are now running trading operations. The yields, it measures yields, and it will buy and sell stocks and positions within portfolios at even large investment banks, large trading houses. Those are algorithmic trading mechanisms, right? We don't do that here. It's all just, what's in our noggins and what our research says. But there's a lot of trading algorithms, a lot of them use Fibonacci. Okay. So because Fibonacci has happened through natural occurrences, they have now been programmed into these algorithms. So now they're even more, they're more apparent to see. You can really see them because you can actually see where the algorithm saw it at 20, 23.8, 38.2. I'm like, okay, the machine said that's enough of it should drop to about this level based on price, based on valuation, based on what's happening in yield, based on what's happening in income, blah, 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 blah. So it should fall to about this range. Maybe the range is, 38% of the move or 35% of the move. So you'll typically see that Fibonacci number show up pretty close And that's the algorithm saying, hey, this is close enough. It's a Fibonacci number, and it's gone. So it's sort of the dog that wagged the tail, and now the tail's wagging the dog a little bit.
So what do you enjoy more, Matt? The conversations about hypothetical, or not hypothetical, but just like theoretical investment philosophies and concepts, or like real time, this is what's going on in the market? 'Cause I like a balance of both of those.
So Yogi Berra said it best. In theory, there is no difference between theory and practice. In practice, there is. So that's why, I mean, I think everybody default loves theory because you can learn it, you can understand it, it makes sense. Practice is different. I mean, whether you're playing a sport, stand at the plate, the ball comes across, you hit in this area, you will hit the ball. But in real life, it's not like that. When you play basketball, like I played basketball as a kid, you run your plays in practice. Well, it never happens in the game. You run the plays in the game, but the defense does something completely different, right? And they account for for the play you're trying to run because they run the same plays that you run, so they know how to defend against it, right? So same thing with the markets, right? Is we all have the same data, so we're all trying to run effectively the same plays. We're all trying to apply the same knowledge, okay? But the defense, which is your market competitors, right? They know the same thing you do, and they know the plays you're trying to run. So how do you stay ahead of them? See what I'm saying? So that's where the practice comes in. You have to look at what's actually happening, okay? Not just what you think is going to happen. That's where sort of fundamental analysis comes in. And for what I was dismissive for many, many years was technical analysis. Oh, I'm a fundamentalist. I look at earnings, I look at economics, I look at interest rates. This is what's going to this way. And for the most part, it's true. Earnings and the markets correlate 94%. We know that through history. But market technicals, because technicals are so utilized now, i.e., if your technical levels you're using are Fibonacci retracements or moving averages, or whether they're simple moving averages or exponential moving averages, Ichimoku clouds, DeMark counts, whatever system it is you're using, Keltner channels, it doesn't matter, okay? They are now part of the zeitgeist of the market trading mechanisms, right? So they affect the market. So you have to be aware that there's those things happening, and that's where the practice comes in. So you can actually see what the decision of the market in real time through the technicals. So to say that there's no wisdom in technicals is a huge mistake. There is a lot of wisdom in the technical aspect and technical analysis, okay? Equal to fundamental. Technical will give you more of a contemporary idea of what's taking place now and what will likely take place in more of the near to intermediate future, whereas your fundamentals earnings, interest rates, will kind of give you more of a longer term look at what we think is going to happen over the course of, a year, 2 years, 4 years, sector based, which sectors we should be using, which parts of the economy are going to contract, which parts of the economy are going to expand. And you have to be able to understand both, right? If you specialize in fixed income, okay, I get that. But typically you'll kind of look at everything through just that prism rather than looking at through small caps, mid caps, large cap growth, large cap value, whatever. It can even get a specialized short duration fixed income, high credit fixed income, all these other things. And they have specialists, and those guys do a great job. Those guys and girls do a wonderful job over there. But as a portfolio manager, because I'm not an analyst, those people are analysts. As a portfolio manager, you have to be able to understand sort of all aspects. Because if okay, well, all right, we're going into we have a hot economy, inflation's running amok, Fed's going to raise interest rates. Okay, so what does that look like? We know how it's going to affect the bond market. Obviously, we're going to have to pull duration way, way back. Okay, but how's that going to affect the equity side? Okay, we know our higher multiple companies and our high dividend companies are going to have a tough time next year. So where do we go? So there's a lot of Venn diagram that happens between those two. So if you understand both well, you'll understand that intersection better, and you'll be a better portfolio manager rather than just being specialized in one area.
You said it took you a while to adapt and really accept technicals, but you did because you understood whether it was your core philosophy or not. The fact that other people thought it was going to affect the market, so you have to know it.
Absolutely, and that goes back to again, communication to the general public and people we see on TV or print media, whatever, and they tend to take a very matter-of-fact singular position. Well, we're not sure that the Fed is done cutting rates. So therefore, we're going to be bullish. We're going to stay bearish. Okay. Or rather than taking into account, well, the market has made a decision. Look at the technical and now look at the technicals. The market has made a decision. Here it is. It is January 19th, 2024. It is 1:30 on the East Coast, 10:30 on the West Coast here. By the way, I fully expect you guys to begin the weekend well for us properly. Thank you.
Next thing on my list, always, man.
The market, the market has officially broken out today, as we speak right now. The market has officially broken out. It's gone beyond its all-time intraday high of 48.18. It's at 48.29 as I'm looking at it right now. The all-time closing low of 47.96 on January 4th of 2020. This all happened on January 4th of 2022. The all-time closing high was 47.96. I believe we'll close higher than that today. That's a breakout. That's an all-time high. So, okay, if you dismiss technicals entirely, and you're again one of these bears who gets on TV and says, "Well, I don't know the earnings in your home." What have you done? Who have you hurt? You've hurt your clients, if you still have any. We did very well for our clients last year. Well, guess what? They like it. So guess what? I like it. I want to do that again and again and again. So whatever set of tools I have to use to stay ahead of the competition and get my clients a return well beyond the market, whether the market's a negative year or a positive year, okay, is what I'm going to do. So I'm not going to pigeonhole myself and say, well, I'm a fundamentalist and earnings growth is going to be 11% and is going to be based on these 7 sectors. So I'm going to deploy capital there and that's what's going to happen and nothing else is going to, but we think the market's not really, we think the market's overpriced. So blah, blah, blah. And then, okay, the market was up 24% last year. Our core portfolio, we call Prosperity 1M, which is our kind of our go-to 23 equity positions. A couple fixed income positions is an 85-15 portfolio, 85% equity, 15% bonds and cash. Finished 44% last year. Okay.
Are those individual? You said 23 equities. Are those individual names or is that a
individual stocks? Correct. Individual stocks. Okay. It's a lot of work to do that, but that's what we're paid for.
I did went down one of those little ADD rabbit holes several years ago about optimal portfolio sizing. And basically found that once you get above about 10 to 12 individual positions, and obviously it depends on the construction of the portfolio and everything, that the benefits of diversification start to exponentially kind of fall off at a certain point, and somewhere in that 20 to 50 range with a sweet spot right around 25 was kind of where I found that 10 would at least give me minimal diversification. But even for my biggest clients, I didn't want to go more than 25. That's about that was enough to me.
Sure. Sure. I mean, I'm a Benjamin Grahamite, right? He's what did he say? If you have more than 30 stocks in your portfolio, you don't know what you're doing. If you have less than 10, you're crazy. Okay. So
there you go. I did not realize that was a Benjamin Graham concept, but yeah, that makes total sense.
Charlie Munger, God rest his soul with his thick Coke bottle glasses. Guy was hilarious. He coined a term, I don't know, wasn't that long ago. Diversification. People over diversify for the purpose of diversifying rather than here's a good set of here's the economy is here. It's going to expand. However, it's not going to expand like a beach ball. It's going to expand like a jellyfish, right? Parts of it are going to expand, other parts are going to contract. Maybe industrials, technology, communication services, healthcare, we believe are going to expand. Consumer discretionary, we believe that's going to expand. Other parts of the economy, maybe consumer staples, materials, those types, utilities, those are probably not going to grow all that much. They probably will grow less than the rest of them, which would actually cause money to flow out of them. So your Sid Cottle investment is a discipline of relative selection. So that's the relative part of, that's what we have. So let's take this perfect sphere at the beginning of the year and figure out what bumps are gonna come out of it. Okay, and where it's gonna cave in. Stay away from where it's caving in and go to where the bumps are gonna be, where the parts of the economy are going to expand. Then you look into those sectors of the economy. Who is doing the best job? Who's got the best leaders? Who's got the best credit? Who's got the best war chest? Who's got the best CFO? Who's expanding their total addressable market better than anyone? Who's going into other parts of the world? Who is doing that? What's happening? And then you start to build that out, right? And that's how we build our portfolios. We use a I use a top-down mentality. I start at the top. Are we going to expand or not? Okay, we are. Where are we going to see the expansion come from? What sectors? Okay. What companies within those sectors are the superstars and why are they the superstars? Okay. And that's how we build the portfolios, right? That's our thesis. We think these areas are going to grow because they have good war chests and then people are utilizing their products more than the others, blah, 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 blah. So when you just buy everything, nothing happens because you have the economy that's expanding by 2%, and then you have 5 sectors that are going to grow by 15%, and you have a set of sectors that aren't going to grow by that much, and you have some sectors that are actually going to contract. So if you're in everything, by the time you're all said and done, well, maybe the whole thing expanded by 2%, and then at the end of the year, your portfolio was up 2%, rather than just trying to find where they're getting to.
Well, and another thing that gets lost on that, and I'll try to make this point really quick, but another thing that gets lost on that is that the effects of compounding math apply to that situation as well. In other words, the difference between picking the best performing sectors and companies of that as opposed to the worst is going to be a very big gap. I mean, you can make money in the best and lose money in the worst. So there is, and then that kind of ties me back to something that I really wanted to make sure we had some time for. One of my favorite quotes is that the market can stay irrational longer than you can stay solvent.
Yep.
Okay. It doesn't matter if the market agrees with you or not. So I love that quote, but you touched on this a minute ago, and I think we kind of got interrupted and never really got to spend more time on it. But it was almost this cycle of humility, right? Where success breeds arrogance, which then makes you stupid and makes it harder for you to replicate your success, right? So
that's a great way to put it. That's a great way to put it. We see that all the time. You know, we have a proprietary screening method that we've developed that works really, really well. And it's based off of earnings growth. It's based off of sales growth. It's based off of, you know, and analyst ratings, all kinds of things. Okay, but it starts there. And then when we go, and once I kind of start, I build we'll build the general chassis of what the portfolio is going to look like. Then I'll start to, that's when I go into the technicals and I start to do comparative analysis of this stock. Okay, if I want to get rid of this one, you know, if I want to add Palo Alto Networks and I want to get rid of Disney. So let's compare the two. And see, is Palo Alto in the nascent or in the stages of outperforming Disney? Okay, because maybe the earnings growth on Palo Alto Networks is really strong. The growth is really, really strong. The price compared to their growth is much, much better. However, they could be far more expensive. So maybe we need to see what the market's saying as a comparison. So I'll compare the two directly inside of one chart, and it's really great. I can do that, and that lets me know. Okay, I think this is a good decision. What does the market think? What is the market saying? What is the market telling me? Because again, it doesn't matter if the market's right or wrong. The market is right. You have to respect the decision of the market, and then I can through this program, I can look at: are we in the nascent stages of this change? Are we in the middle stages of this change? Or this outperformance? Or are we in or is it starting to roll over and potentially going the other way? Am I late to this? Am I late to this game? Right? And I can do, and that's what we look at. So that's where we use a lot of technicals for is where are we at? I like this for these set of fundamental reasons, but where are we at in this trade? Are we too far down the road? Are we going to roll over soon? And we're not going to be 100% correct, of course not. But it gives us an idea of what the market's deciding on. So you just have to understand both sides, just like you have to understand you know, you have to be a good fixed income manager to be a good equity person, a good equity manager, in my opinion, and be able to bring them together. You know, as we're looking at the markets, we're looking at the bond markets this year. You know, we really grabbed it last year. It wasn't probably the best thing to do, but we grabbed pretty much the long end of the curve using the TLT, the 20-year. This year's different. You know, as we think the shorter end of the curve is going to come down, and the spread of the mortgages are going to come into more of a normal range. Typically, we see that range 1.65% between the 10-year Treasury note and the 30-year fixed mortgage. That relationship is 1.65% historically. It's much higher. That's about 3% right now. Okay, so as the Fed starts to lower rates on the policy end, starts to lower their policy rate, that's going to bring that short end of the curve down. That's going to bring mortgage rates down. That's going to tighten up that spread. So we're not going into real estate this year, but we're going into mortgage-backed securities on the fixed income side. And then we're really going to grab that belly of the curve. We've got the mortgage-backed securities, and we've got a big position in 3 to 7s, and then we've got a big position in 7 to 10s, and then we have another smaller position out in 10 to 20s. We didn't just grab the 20. See what I'm saying? And I know as those start to come down, we think industrials are going to do much better in this space. We think healthcare is going to do really well this year. We think tech is going to continue to outperform this year. We think comm service is going to continue to outperform this year. And we think consumer discretionary is going to do well this year as interest rates start to come down, autos, home, those things will start to do better. So there absolutely is an overlap there. Again, back to that Venn diagram. But as we look at these things, and I was doing some analysis here on 2024, 2025 earnings growth on these different sectors as viewed through the sector ETFs, right? So like industrials, you know, we're seeing about 11.2% earnings growth this year and 13.3% in 2025. Okay, that looks good. Tech, 14% earnings growth this year, probably 17% in 2025. Now it's a more expensive sector, but I think it's still growing. So when we juxtapose that against, I don't know, let's pick on home builders. I like home builders in a decreasing mortgage rate environment. Earnings growth this year is going to be 2.8%, 2025, 9%. I think it's going to be a strong sector, but there's going to be less earnings growth. A lot of people are bullish on banks this year. Okay.
On what?
I don't know that they're going to be wrong or right. I don't know, but through an earnings spectrum, we're looking at about 6% earnings growth this year and about 11.5% next year. Okay. Again, relative selection. Do I want to be there? Or do I want to be in healthcare where it's probably 20% this year and 13% in 2025? And again, back to tech and small caps is viewed through the IWM. We're going to get 26% earnings growth this year, you know, and 24% in 2025. So, you know, as I start to look at these earnings growth patterns, okay, then I can go into the technical side and start comparing the two against each other. Okay, let's look at the XLF against the XLV. Okay, is the XLF underperforming and continuing to underperform? I don't want to be in that trade. I want my charts up and to the right. Okay, that's what we do. In fact, we talked about that in I believe it was one of our earlier shows. It was middle of October. We said there was going to be a chase toward the end of the year, and we got it. Yeah. What are you going to step into? You're not going to step into anything that's going down, hoping it's going to turn and go the other way. You're going to step into whatever positions you can that are up and to the right, because you need to get on that road. You need to get on that road. So that's, you know, that's
the concept. And that's the concept of not catching the falling knife. A lot of people will say, don't try to catch the falling knife. So the fact is, whether that's good philosophy or bad philosophy doesn't matter. The fact is, it's real philosophy, right? Like, it happens. So there's a reason that it's very hard to change the direction of a falling stock. It's because most people avoid those. I mean, there are all these different, they're not even fallacies, they're just approaches. The fallacy is ignoring them. You know what I mean?
Yeah, that's happening right now, actually. Sorry to interrupt. But I think you're going to see a lot of people try to catch Boeing. Right now, Boeing's down from 260 down to 210 or 215 right now. I think you're going to see a lot of people trying to catch the bottom of this thing. We took a quick look at this. I think it's probably going to go to 185, 190 before I would get brave with it. You see what I'm saying? So, you know,
and that's where there's that.
I want to see it go there and then turn around and go the other way. I want to get on the plane. I don't want to try to catch it.
Yeah. And I think that's a great point there on the concepts of the show and what you said earlier about theory versus like real time, because that's a theory that I totally agree with, but it could be 30 minutes of show. We can bring up 2 minutes of that to talk about a real example right now, like Boeing, right? But the point is, it's all of there is such a delicate dance, and there's such a choreography really to navigate in the markets the right way. And it takes understanding the science behind what you need to do, plus the analytics and the art form of understanding that everybody's opinion matters. Whose matters the most today is what's very fluid.
Right.
Well, dude, before we go, let me make sure we're clear on this, that the Intelligent Investment Market Update is for educational and informative purposes only. Neither myself nor Matt know anything about your personal financial situation. Therefore, we should not be giving you investment advice, so we are not. Would your attorneys like you to say it differently, Matt?
Absolutely not. Please consult your own investment professional for any of your portfolio.
Or Matt.
Or feel free to give us a call right here at ARPG. Our number is 702-655-8300. Any one of our advisors would be happy to talk with you and get you pointed in the right direction.
There you go, my man. I think we just nailed the exit. I think that's the permanent outro right there. Perfect.
Make sure your weekend is up and to the right.
See you, man. Talk to you soon.